What's going on, everybody? And welcome back to another episode of the Trade for Yourself podcast, where my mission here is very simple. I just want to help you learn how to trade for yourself. So make sure that you please subscribe, please share the episode because I would really truly appreciate it. Please note that anything discussed in this episode is not financial advice, so please do your own research before investing into any stock. This episode is going to be talking about the fact that we need to have a conversation about the stock market beginning to have a new bull market. And I'm taking this episode to put multiple things from an economic perspective and a technical perspective into context for the reason why I believe that the stock market may be getting ready to start another bull market. Please be patient with me. Please listen to this episode throughout the entirety because you do not want to miss anything, okay? Let's get into it. Okay, everybody. So what is a bull market? And based on Investopedia definition, a bull market is the condition of a financial market in which prices are rising or are expected to rise, okay? The term bull market is most often used to refer to the stock market, but can be applied to anything that is traded, such as bonds, real estate, currencies, and commodities. Now, the commonly accepted definition of a bull market is when stock prices rise by 20% after two declines of 20% each. That's very, very important. Also, put this into perspective, there is no specific and universal metrics used to identify a bull market. Nonetheless, perhaps the most common definition of a bull market is a situation in which stock prices rise by 20% or more from recent lows. That's going to be very, very important later on in this episode. Okay, so what is a bear market now? A bear market is when a market experiences prolonged price declines. It typically describes a condition in which securities prices fall 20% or more from recent highs amid widespread pessimism and negative investor sentiment. And that is what we went through. Now, this is based on Investopedia. Let's look at the phases of the bear market. And bear markets usually have four phases. The first phase is characterized by high prices and high investor sentiment. Towards the end of this phase, investors tend to drop out of the markets and take in profits. In the second phase, stock prices begin to fall sharply. Trading activity and corporate profits begin to drop, and economic indicators that may have once been positive start to become below average. Some investors begin to panic as sentiment starts to fall. This is referred to as capitulation. The third phase shows speculators start to enter the market, consequently raising some prices and trading volume. In the fourth and last phase, stock prices continue to drop, but slowly. As low prices and good news starts to attract investors again, bear markets start to lead to bull markets. And my argument in this episode is that we are in phase 4 of this particular bear market. Now, why do I believe that? Now, the reason why I believe that is because I want to put this into context based on this chart, okay? This chart is showing us S&P 500 bear markets and recoveries, okay? And in the dark blue, we have the length of bear market in months. And in the yellowish color, we've got length of recovery in months. So what is this definition? Based on this definition, the length of the bear market is the time that it takes to go from the previous cycle high all the way down to the bear market low. The length from the previous cycle high down to the bear market low. The length of recovery is how long it takes for us to go from the bear market low all the way back to the previous all-time high. And I did something great for y'all today. I did something great. I went ahead and did the math before time. So let me give you some statistics, okay? On average, based on these bear markets that are on this screen, the length of a bear market in months is 13 months. So there's 13 months on average in length for a bear market. But the length of a recovery on average is 23 and a half months. So based on this statistic, it takes the market about on average 10 and a half more months to recover than it takes for the market to actually drop. Okay, put that into perspective. What that means is that it's going to take us more time to get back to the all-time highs than it's going to be for us to actually make the negative drop. And I think that we've been in this bear market for so long, and we've been in this bear market for longer than average. Now I think it's time for us to start making that recovery. Okay, now we can look at these statistics, but we can't just look at these statistics and just take them for face value. What I want to do for y'all today is put these statistics in perspective by looking at the risk that the stock market is dealing with and try to make a case that these risks are not that big of a deal from a probability perspective. Okay, so the first thing I want us to put into perspective is inflation. Think about this. Remember, last year in 2022, the first half of 2022 was the worst first half that we had in almost 50 years because of inflation, right? That was the main reason. And so if we look at this in June 2022, the CPI, the Consumer Price Index, which measures the 12-month percentage change in inflation, was at 9.1%. That's 40-year highs, right? But the last number that we got, which is the December 2022 number, was 6.5%. So we are much lower than where we were, right, in terms of CPI. Now, this is the median consumer price index. This is the PCE index number. Now, this is the Federal Reserve economic data, and this is the CPI number that the Fed looks at. This is the percentage change at annual rate. This is the monthly change. Now, in June, we were at 9.13, and in August, we were at 9.92. But if you look at this chart, this was considered a double top, right? This is a double top, a bearish pattern. But now, based on the December number, we are at 4.62. Okay, so put that into perspective. We are much lower, okay, in the inflation situation. We are not dealing with the level of inflation that we were dealing with last year. And my argument is that inflation is not going to tick back up or reinvigorate like people fear that it is. I believe that inflation is going to continue to come down. Will it take a long time? Yes. Will it be relatively sticky in certain areas such as housing? Yes. But what I will tell you is that it will continue to come down. And if you look at this, Federal Reserve Chairman Jerome Powell, he said that inflation is starting to ease, but interest rates are still likely to rise. He said that the disinflationary process has begun, but it is going to take time. Okay. I don't have an issue with him saying that because he is acknowledging that we are going in the correct direction in terms of inflation. Now, I bring up Federal Reserve Chairman Jerome Powell because that leads me into my next point, which is what the federal rate, right? The federal funds rate. Okay, now we have been hiking this federal funds rate so much, right? If you look at this chart right here shows us how much the Fed has raised interest rates. 25 basis points, then 50 basis points, then 4 straight moves of 75 basis points. Unprecedented situation that we were dealing with last year. Then guess what? We stepped down to 50 basis points. Then we stepped down to 25 basis points, right? What does this tell me, right? A big risk in the economy this year was that the Fed was going to raise rates too high, and that was going to cause the Fed to crash the economy. Check this out. By Jerome Powell doing what he is doing and the FOMC committee lowering rates like they are, this is pretty much telling us that the next few interest rate hikes that he has are only going to be 25 basis points. Okay, they're only going to be 25 basis points. He's not going to go any higher. Why do I believe that? The reason why I believe that is because he just admitted that the disinflationary process is underway. He is understanding that we are fighting inflation and that we are actually beginning to win this war that we have on inflation. It's going to take time. At the end of the day, it is going to take time. Yes, the federal funds rate may continue to increase, but it will only increase by 25 basis points intervals, and the market will take that very, very nicely because Jerome Powell is not going to scare the market by going from 25, then going back up to 50. Now, if he were to do that, that would obviously crash the market, and that would kill this thesis that I'm giving you guys. But this is what I'm telling you: 25 basis points is what you should expect, and it's going to be very, very measured. It's not going to be all at once. He's going to take a measured approach and be data dependent. As long as inflation is continuing to come down, we're not really going to have to worry about the Fed this year as much as we did last year. Now, what if I were to tell you that the United States is not going to go into a recession this year? Okay, why would I say that? Because of the unemployment rate. The unemployment rate is 3.4%. 3.4%. That is very, very low. My argument behind that is that we cannot go into a recession if nobody loses their job. The unemployment rate is lower than where we were before the pandemic. It's lower than pre-pandemic levels. So how are we going to go into a recession if nobody loses their job? Now, I will provide a little bit of context behind the unemployment rate. Let me tell you about how it's calculated. The unemployment rate is calculated based on the labor force participation rate. What that means is that you are not included in this unemployment rate calculation unless you are actually actively seeking work. And the number of people actually actively seeking work has gone down, and it is lower than where it was pre-pandemic. But nonetheless, what does a 3.4% unemployment rate tell you? It tells you that the demand for workers is extremely, extremely high, and employers are still trying to find workers. Look at what we had in January 2023. Total non-farm payroll employment rose by 517,000 in the month of January, and the unemployment rate changed little at 3.4%. Job growth was widespread, led by gains in leisure and hospitality, professional and business services, and healthcare. Employment also increased in government, partially reflecting the return of workers from a strike. Take this into consideration now. It's not just one industry. It's a multitude of industries that need workers, okay? My argument is that we are not going to go into a recession in 2023 if people do not really start losing their jobs. People are still making money. Average hourly earnings are continuing to increase. So I'm telling you, I don't believe we're going to go into a recession. And a recession was what? Another major risk for the reason why the market could go lower. If we don't go into a recession, what is going to take us back down to those lows that we had in October? What's going to take us to 3,200 or the pre-COVID high or whatever? What's going to take us to that? Nothing is going to take us to that if people do not lose their jobs. Now, the last thing I want to point out from an economic perspective is China's January factory activity returns to growth as economists cheer its reopening. China's official manufacturing purchasing managers index, PMI for short, rose to 50.1% in January, above the 50-point mark that separates growth from contraction. That's very, very key. This set of PMI data confirmed that earlier reopening and peak infections have set the stage for a broad-based economic recovery, city economists wrote in a note. Now, this is a very, very big deal. The reason why this is a big deal to me is because I always like to remind people this: the best companies in America are global companies, okay? They get their sales globally. China is the second biggest economy in the world. What if there is a lot of pent-up demand by a lot of Chinese consumers and they want to spend money? Who is that going to benefit? It's going to benefit companies like Nike, companies like Apple, companies like Tesla, companies in artificial intelligence like Nvidia, and other major companies that can profit and get a large portion of their revenue from the Chinese consumer. So Chinese consumers may be spending money. Why is that so important? Because every economist and every analyst is telling you that earnings are going to drop and fall off of a cliff. If the Chinese consumer comes back and actually helps to foster up earnings, right, and actually spends money, and if China comes online and they are producing things because they're sending things to America, and we as Americans are continuing to spend money, and we still have elevated saving rates in our banks, we still actually have money. What that means is that there's a possibility, I'm not saying that this is true, that the earnings contraction that everybody is expecting could actually be an earnings expansion year over year. And mind you this, the S&P 500 can still go up even if earnings contract, because the S&P 500 has done it before. So I'm telling you, you really, really, really want to watch China, because this could really, truly be a game changer for us and really put that icing all on the proverbial cake. Okay, y'all, so I really hope y'all made it to the end of this episode, because now I'm about to wrap all of this up with the charts. Okay, we're going to look at the charts that's going to support everything that I have said from an economic standpoint. So let's go back to the bull market. I told you this definition was going to be very, very important. Look at these two definitions. The commonly accepted definition of a bull market is when stock prices rise by 20% after two declines of 20% each. Very, very important. Stock prices rise by 20% after two declines of 20% each. So this is a chart of the S&P 500. This is SPX, right? And we're showing you the last data that we've been going through since the beginning of 2022. And so you see that we've had a downtrend, right? Series of downtrends. But I have some trend lines here marked in white. And with Thinkorswim, you can hover over trend lines. So when you look at this first trend line, this was the first major decline that we had. This was our first major low that we had. And we declined 24.5% from the high, right? We had a great run up. We had a great run up over the summer. But what happened again? We had another decline. We had another decline of 19.28%. Okay, that's right there in that 20% ballpark that we talked about. And then we made that lower low. But then from October, when we had that bad CPI number, what has happened? The stock market has gone up 19.62%, which you can literally round up to 20%. And if you look at where we are and you look at where we were last week, we actually hit that 20% threshold last week. Okay, so remember that definition. We met that mark of that definition, okay? What's the next definition? The second definition that Investopedia gave us. The most common definition of a bull market is a situation in which stock prices rise by 20% or more from recent lows. This right here, if we can assume, right, we can make an assumption and a probability to say that this was the market low, we are 20% above the market low. This is why I'm saying that we need to have a conversation about a new bull market starting. I'm not telling you the stock market is going all the way back up here to 4,800 tomorrow. It's not what I'm telling you. I'm making an argument that the probability of us breaking this low right here is very, very low based on everything that we've talked about in this episode. Okay, let's go to my second point. Second point, look at what the S&P 500 is doing around this key level of 4,100, right? So I have the 4,100 level marked in gold, but I also have these oval shapes marked in gray that mark the key touches around this level. We had support here earlier in February of 2022, which was almost a year ago. We had resistance here in September. We had a double top right here, a double top, okay, that we actually broke out of. We had a small area of resistance, and then based on this, our gray oval, we have support. Okay, so This particular level has turned into resistance and support. Remember this, when a level goes back and forth between resistance and support, it is an extremely, extremely, extremely key level, and we need to watch what stock prices do off of that. Once we broke above this 4,100, stocks have not closed below 4,100 yet, right? Does it mean that stocks won't come back down a little bit? No, it won't. But what this definitely means is that 4,100 is a very, very key level, and the stock market has been able to hold it. The bulls right now have been able to hold it, and that is very, very important. Now, the last thing I want to talk about is break of trend. Okay, break of trend, market structure. What is market structure? Market structure is when we see a bear market, we see a series of lower highs and lower lows, right? Continuing to make lower highs and lower lows, right? In bull markets, we tend to see areas to where we see higher highs and higher lows. So in the year of 2022, we were clearly in a bear market, clearly lower lows, lower highs. We had the high, had a low. Lower high, we had the high, then we had a lower low. Lower high, lower lows. Lower highs, lower lows. This is still a lower high because you look at how it kissed this trend, and we made that lower low, which I believe may be the final lower low. Because look at what we have done. We have broken trend on the S&P 500. Literally, we have broken the trend because we have had this low, but we've had a higher high. Came down and had a higher low. We have not came back down to this low level, and we are pushing back higher. We have broken this trend line, and we are respecting this trend line. My argument is that if we respect this trend line, or we do not make a lower low and we continue to make another higher high, I believe that the market can continue on this upward momentum and continue to have positive trajectory. Remember what I said. Please remember this. I'm not telling you, and this is really, truly very, very important in this entire episode. This entire episode is not meant to tell you that we're going back to 4,800 tomorrow or next week. I don't know when we're going back to 4,800. What I'm telling you is that we need to start having the conversation. And the main reason why we need to have the conversation is because in bear markets, we spend more time in recovery in bear markets than we do actually getting to the low. So my point is, if you do not build your positions during the bear market while we are in recovery, by the time we get back to a bull market and everybody on CNBC and Bloomberg and Yahoo Finance, The Street, this, that, and the third, whatever publication that you listen to, by the time they tell you it's a bull market again, you've missed all the opportunity to get these prices the way that we were when we were talking about Tesla, when we were talking about AMD, when we were talking about Apple, when we were talking about Microsoft, when we were talking about TSM, when we were talking about all of these companies. This is what I'm telling you. This is why this is important. I really, really, really hope y'all made it to the end, because this is the perspective. You gotta put it all into perspective to really truly see what I'm really, really saying here. So to summarize this episode up, I believe that the S&P 500 is starting a new bull market. Just think about all of the risks that we had in 2022 and just ask yourself the question, what is the probability of those risks causing the stock market to make new lows? That's the major thing, because like I said, and like I really wanted to get over in this episode, I'm not saying that the S&P 500 is going back to an all-time high tomorrow, because at the end of the day, remember what I said. In bear market cycles, we spend more time in recovery than we do actually traveling down to the bear market cycle low. And so it's going to take time for us to get to those all-time highs. We may go sideways. We may chop. We do not know. But we need to take in the probabilities, and let's start having these conversations like I always talk about. Buying the stock market every single month, dollar cost averaging. That is going to help you build a position so you can take advantage of the great prices that we had in this bear market. And whenever the media tells us that we are in a bull market, you can then enjoy the fruits of your labor. As always, I thank you all for tapping into another episode of the Trade for Yourself podcast, okay? Please like this. Please subscribe. Please share. Please make sure you hit that notification bell so you can be in the know every single time I drop an episode. Reach out to me in the comments. Do you agree with me? Do you disagree with me? Does my argument actually make sense? I want you all to tell me, where are the holes in this argument so I can possibly go back to the drawing board and maybe, make some things different and shake some things up. As always, remember, don't pay for it. Trade for it. I'm going to tap in with y'all in the next episode.